So my name is Don Durrett. I have a website called Gold Stock Data. It has about 850 stocks in it. I'm an investor like you guys. I started basically accumulating mining stocks in 2004. I have 47 silver miners and 118 gold miners, about 160 stocks. So I keep accumulating, and I'm waiting for a once in a time. I think this is going to be a once in a time, once in a generation, once in a lifetime opportunity, if you will, because I think gold's going to $4,000. So I've been accumulating stocks all this time, waiting for it. And I've learned a lot, so that's what you guys get to learn today. 220, I'm going to talk about 15 must-own silver stocks, so back here at 220. So after I started investing in 2004, I didn't know anything. There was no books. I couldn't find a single one. This is the only book. The 10th edition, I just finished it, so you guys want to write it. So what I'm going to go over today is in my book. This is the only book that teaches you how to analyze gold and silver mining stocks, by the way. I've never found another one. This is my website. As, like I said, 850 stocks in it. The entry price is $199. People say that I give too much value. There's a lot of excellent value in this database for $200. Again, just access to the database alone is worth the money, but you get a lot more. For instance, I rate every company. You can see up there in the right corner, it says category, rating, and risk. So the rating is three numbers, 2, 3.5, and A+. I do that for all the companies. So you can see my opinion of these companies, and I know these companies inside and out. This is my profile on Twitter, so you guys can follow me. I also have a community on Twitter that I created that basically keeps the bots out. Oh, I can see it. Okay, so now we're going to start exploration stocks. So these are kind of my rules, my general rules, if you will, that I've learned. So the first thing, you want to make sure you have high conviction. Avoid lottery picks. If you don't have really high conviction in an exploration stock, do not buy it. Secondly, ideally you want a company that already has a large deposit and is undervalued. I call these optionality plays. I'll give you one example, is Free Gold Ventures. They have 30 million ounces in the ground. They're valued under $10 an ounce. You're buying gold in the ground for $10. And they have really strong insiders. Eric Sprott owns 29%. Another group owns about 25%. So two private groups basically own 50% of the shares. They're not selling. So those are the kind of exploration stories that I like. You always want to get in and not chase breakouts. So you want to get in early. So for me, I want to get in, say, before $75 million. If they have a market cap of 75, I'm very picky. I'm probably not going to chase it. So you want to get in early. It's hard for me to see these. The best drill stories are those that have high likelihood of expanding a known discovery and is undervalued. So you want to make sure that they already have a discovery. If you don't really want to buy an exploration stock that doesn't have one. So what I've learned is I want to avoid exploration stories that do not have what I call an excellent discovery hole. So I created my own little spreadsheet here. Those two top lines are what you're looking for gold and silver. These are gram meter holes. Some guy did research a few years ago and identified what these gram meter holes are, what you're looking for. And he found that big deposits generally always have an excellent hole. So you see column 4 where it has excellent. If they don't have a gram meter hole above 200, then you basically avoid it. You wait until they have that hole. Silver's 2,000. I have a YouTube video that explains how to analyze. That's where this chart came from, so you can look that up. If you go to YouTube and go look for Don Durrett, you'll find that YouTube video. Location is important. The reason why is because it can impact how much it costs for them to drill, if they can drill year-round, the ease of development, and the value of the company. I mentioned Free Gold Ventures earlier. One of the reasons why it's so valuable is because the location. it's just north of Fairbanks in a really good location, that's what you're looking for. Insider's important. The reason why is because you don't want these companies to sell early. If they don't have 25% or more, then they're more likely to sell early, or they're more likely to dilute you. So I'm really big on insiders. Now, I try to keep my allocations low. I mentioned this earlier if you were here, some of the reasons why to avoid exploration stocks. And so I think the risk reward in exploration stocks is not that good. And so I keep my allocation only about 5% of my total cost basis. And then if you avoid exploration stocks completely, that might be a smart decision. The reason why is because I call them one and done stocks. And the reason why they're one and done is because usually when you invest in an exploration stock, you're investing really for one discovery hole, and you're chasing that discovery hole. And then once they sell it, it's over, it's done. You move on to the next company. Where if you're in development or producers, those companies can grow. Okay, development stocks. So I've created these check boxes. And if a company doesn't have all 6 check boxes, then you pass. So the first one is it has to have a strong project. This is good location, long mine life, good economics. And as an investor, you need to learn what those things mean. High upside potential. I only invest in developer plays that have at least a 10-bagger. Now, that's a 10-bagger at $4,000 gold. I always focus on the future. And the reason why you want that high upside is because it has to coincide with the risk. There's tons of risk with development plays. Good location. Ideally, you want to find development plays that are already in a mining district or mining-friendly country. Strong management team. Development, it's really difficult to build and operate your first mine, and that's what we're talking about with a development stock. It's generally your first mine. So that mining team is really important. And I think I have 29% of my portfolio in development stocks, and half of those are on management teams that are iffy, if you will. I'm gambling. So that's where that high risk, that's why it has to have at least a 10-bagger. I say usually only about 20-25% of your development plays actually pay off. That's how much risk there is in development plays. They might look fantastic, but the risk reward is not fantastic. You're betting. They have to have a path to production. This is probably the biggest mistake you're going to miss. You want to make sure these companies have a plan. And I roast these CEOs all the time when I interview them because they don't have a solid plan. And the companies that have good plans, I pat them on the back. Say, good for you, because they get it. Example is Silver Tiger with Glenn Jessom. You listen to him, that guy's got a plan. He knows exactly what he wants to do and how he's going to carry it out. They don't have a plan, walk away. Strong insiders, this is another one. If they don't have strong insiders, chances are they're going to sell the project before first pour. You want them to get to first pour. By the way, this presentation I'm giving, you guys can go to my website, send me an email, I'll send you the presentation. NAV CapEx. This is a real simple rule that a lot of people might miss. So when they come out with their PEA, if the CapEx is close to the NAV, that's not good. Because the reason why it's not good is it's going to be tough for them to finance. It's also, they're not going to be as aggressive on developing it. And, they languish. You want that NAV to be about twice the CapEx, then it's okay. 3x, 4x. Vizsla's was 5x, which was crazy. You rarely see that. 2x is fine, but anything better than that is good. But it's important that the NAV CapEx is going to literally tell you the economics. It's a real good number to go by. Allocation. So, again, I mentioned earlier that these stocks are very risky, but I like to allocate 20 to 25% because the ones that work are going to really work. And you can have huge returns, the ones that do work. The other thing I like about development stories is they can turn into producers, and I want to own as many producers as I can. So I'm a little more aggressive on development stocks than maybe the average person, but I do like them. So producers is my last section. We're doing good on time. I got 10 minutes. Okay, I can actually slow down a little bit for the last one. And producers, I think, are the most important. If you were here earlier, I talked about how I like to be overweight producers, and I own about 50% of my portfolio as producer, and I want it to grow to about 60, because I believe producers, I mean, right now, the silver producers, it's easy to get a 5-bagger today with a silver producer, which is crazy, because we're still early. Once the HUI gets to about 350, within 3 months, all the silver producers will have doubled in value, and there goes your upside. But if you buy them today, they're great. So you want to avoid pricey stocks. So this is less than a 3-bagger. Well, guess what? Newmont's a 4-bagger today. So it's pretty hard to find a pricey producer today, which is great. So you can buy as many producers as you want. I don't know. It's pretty insane how cheap these companies are. You want to avoid high-risk locations. So in my book, I mentioned those high-risk locations. That's something you need to learn. Avoid high ASIC costs. So there's any producer, and this changes. I call this 2/3 the price of gold, the spot price. If you take the gold price and you multiply it by 0.66, you don't want the ASIC to be above that. Well, actually, that's the all-in cost. That's not even the ASIC. Because I take the ASIC and I always pad it by about $300 to $400. So right now, basically my point on high cost is the reason why you don't want these high cost producers is investors just aren't gonna like them as much. They're not gonna get high multiples. You want companies that are generating a boatload of cash. So you don't want to kind of go over the limit, if you will. Like today, if a company has, Equinox, for instance, is a high-cost producer today, but I own it. But the reason why I own it is because I think their costs are going to come down. Now, some people say that Newmont has high cost today, and their ASIC is about, I think, $1,650, I believe. And so they're just a little bit below, but I think Newmont will come down. So anything 1650, 1700, 1800, 1850 ASICs, those stocks you want to be a little bit more choosy with. But ideally, you're looking for ASICs around $1,000 if you can find them. Like Dundee and Orla have really good cost models. But the thing that's nice about companies that have good cost models, ASICs, anywhere 1,000 to 1,200. The reason why is it just gives you a lot of room for error, if you will. They can make a mistake. Their cost can go up $100. It's not going to bite you. They're still going to generate a lot of cash. And then if gold goes to 3,500, 4,000, these companies are going to generate a lot of cash. And that's what we're after. I chase cash flow. That's what I want. And so avoid small producers unless they have a pipeline. The reason why is they generally do not have enough free cash flow to grow production. I avoid small producers as a general rule, but I do own a few of them, but they're the exception. You don't want to get excited about small companies, small producers. What you want to look for in producers is companies that what I call sharks. These are companies that are trying to grow. I like aggressive companies. I don't like conservative companies. I want companies that are out there trying to grow their production, trying to grow their reserves. Now, there's a trade-off here. Some of these companies, when they do that, they end up hurting shareholders because they spend money too quickly, too rapidly. Even a deal can even be accretive, but sometimes it can hurt shareholders. So there's a fine line there. That's where the smart companies come in. But on the whole, I want a company that's aggressive. I want a company that wants to grow. Like some of these companies, they basically sit on what they have, if you will. They're like cash cows. They won't take a chance. They won't take a risk. Basically, they won't bet on the future. They won't bet on higher gold prices. They won't bet on higher silver prices. I want companies that are going to do that. They're going to gamble. They're going to basically say, for instance, Avino Silver. Nobody will buy Avino Silver today because they don't believe silver's going higher. But look how cheap Avino is at higher silver prices. Why isn't somebody right now, why isn't Hecla? Endeavor walked away from it. Endeavor owned, I think, 12% of their shares, and they sold them all. Hecla won't buy Avino because they're like, oh, it's not cost effective. It doesn't fit our model. But it sure does at $50 silver. But nobody will gamble on it. You see what I mean? So I want somebody that's aggressive that goes out there and say, I see what Avino has at higher silver price. I'm going to buy it. So that's what we're looking for. Okay, so you want to look for companies that have solid free cash flow and an excellent long life mine. So I mentioned this earlier when I was talking about the high ASIC that you want to be careful of. So one of the things that we want to look for with a producer is we want to look for a company that has a really strong long life mine. I call these flagships. So if a company has a really strong mine, they can basically build off of it. That is basically what I call a company maker. If you have that one strong mine, then you can build a company into 2, 3, 4 mines. So I'm really big on companies that have these company builder mines. And so you look for these flagship properties that they have, and they can build on them. And you look for these flagship properties that are growing in size. You can get really excited about those. Like K92 Mining, I mean, they're going to be drilling that property for 10 more years. It's like 8 grams per ton head grade. It's going to be 8 grams. So it's very high grade, and it just keeps getting bigger and bigger and bigger. I think they're heading to 400,000 production. That thing's going to end up being 600,000 production. And they're a conservative management team. I mentioned earlier that I wanted more aggressive ones. They drill, they do not overspend, they take their time, they just drill the same every year. They have drill targets all over the place, but they're not going to do it. They've never bought another company. I wish they would, but it's still, that's the type of property that you're looking for, that a company, they can build on. I mean, if you look at companies like Hecla and Coeur, they basically have built those companies around kind of company maker projects. So that's what you're kind of looking for. You want these fantastic properties that you can basically, that have a mine life of like at least 12 years, 12, 15 years. Yeah, we have about 2 minutes left. The next thing is the balance sheet. So you want to look for companies that have, I like good balance sheets. So the ideal balance sheet for me is $100 million in cash and no debt. I want companies to be cash focused. So if they borrow money, I only want them to borrow money to build a mine. And then after they build the mine, I want them to pay that debt off within, say, 3 years. And then so if a company has, let's say, $250 million, $500 million in cash in their balance sheet and no debt, it gives them so much flexibility. It allows them to borrow against that money. It allows them to build new mines. It allows them to buy back stock. It allows them to give dividends. It's just a beautiful situation. But ironically, in the mining business, there's few companies that do this. Kirkland Lake did it, and then they went away. They were the only major that did it. They had over $500 million in cash in their balance sheet. I think at one time they had at least $700 million of cash in their balance sheet. Their free cash multiple was 25. Investors loved it. Guess what? They got taken out, and now that company that bought them, Agnico Eagle, has like $1 billion in debt on their balance sheet. So that model, nobody else is following, even though Kirkland Lake showed everybody how to do it. Westgold in Australia, I talked to their CEO. I got 12 seconds. He told me he was going to do that model. I like to allocate, I got to get to my allocation, about 50% to miners. Okay, how I allocate. I'm running out of time. So here's how I allocate. 7% physical silver, crypto 6%, mutual ETFs, mutual funds 16, producers 33, developers 29, explorers 7 today when I'm too much. I need to get down to 5, and then cash only 2%. I never like cash. Got to put it to work. That's all the time. Thank you, guys.